Up until now, we've been building the architecture of forecasting, but in this video, the system becomes operational. Because in this episode, we are going to take a complete set of personal financial statements, analyze them, identify forecasting relationships, and extend the system 5 years into the future. And importantly, I'm assuming you already have your own recent financial statements prepared, meaning your personal income statement, your net worth statement, your cash flow statement, and ideally your contribution income statement. Because forecasting begins with accurate structure, and once the structure exists, the future can begin taking shape. This is where personal finance evolves into financial systems engineering. The objective of forecasting is not perfect prediction, as I've stated in past videos. The objective is strategic awareness. Forecasting helps us identify where pressure accumulates, where fragility develops, where liquidity compresses, where optionality improves, and where the system becomes unstable. This is critically important because most households operate reactively. They wait for inflation, debt pressure, job loss, rising interest rates, or emergencies before adjusting behavior. But strong systems prepare before the pressure arrives. And forecasting allows us to see future trajectories before we experience them. We begin with the personal income statement, because the income statement measures economic activity, not merely cash movement, and this distinction matters enormously. For example, mortgage principal repayment does not appear on the income statement, only mortgage interest expense. Because principal repayment reduces a liability, it is not an expense. This is one of the most important conceptual foundations in the entire system. The income statement may include gross income, utilities, groceries, transportation, insurance, subscriptions, depreciation expense on your vehicles, interest expense, payroll-related expenses like EI, and income tax expense. Your situation is going to be unique to you, but these are some examples of the things that you would find. And importantly, income tax expense should appear near the bottom of the statement just before net income, because tax expense is often determined by forecasted taxable income, meaning even taxes become driver-based forecast variables. Now, if we look at this image, we can see that at the top we have our gross income and we have the current year. Now, the way that this one's set up is the payroll-related expenses are listed directly under, and this gives us our net income before expenses. But I would suggest that you follow the method that I've used in Series 1 and Series 2 to set up those types of payroll-related expenses. Next, we have our different expenses categorized based on the forecast method. So the first group is fixed expenses. These are all forecasts using the forecast method of fixed. We have variable expenses, groceries, dining and entertainment, transportation. These are things that are set as a percentage of income. So when we look at the current year at groceries, we see $9,900 as the annual amount. This represents approximately 9% when taken at a percent of 110,000. So when we forecast income the following year using a growth rate of 5%, and our income grows to 115,500, we have to grow these percentage of income by the same amount. So the 9% of 115,500 turns out to be the amount for the groceries, 10,593. So these ones change as a percent of income. For inflation sensitive, we use inflation linking. So if our utilities was 4,200, we multiply that times 1.038 because, or whatever the interest or the inflation rate is that we've assumed. And it looks like in this case, it could be 1 or maybe 1.5% is the inflation rate assumption, okay? Or whatever the case is. You just have to make sure that whatever your inflation linked rate is that you multiply the original current year base by 1 plus the inflation rate raised to the exponent 1 for year 1, 2 for year 2, 3 for year 3, and so on and so forth. We have our interest expense and our depreciation expense. These are schedule driven. These are based on the amortization schedule and the depreciation schedule. And then lastly, we have these behavioral or discretionary expenses that we, have to deal with in terms of, putting a forecast on these. And you would just sort of forecast these, whatever you feel is an appropriate depiction of reality. After we do that, we get our income our income before tax. We then take our income tax expense, and given that it is 15%, and this is average tax, not marginal tax, this is the average. So if you paid $16,500 taxes on $110,000, then the average tax would be 15%. Then we just take again that 15% and we apply it to the increased gross income for year 1, for 2, 3, etc. That then gives us our net income, as you can see on the bottom line, for the current year, years 1, 2, 3, 4, and 5. And ideally, if you've got this structured correctly, that net income figure is going to be growing rather than shrinking. Next, we examine the net worth statement. Because forecasting does not only involve income and expenses, it also involves assets, liabilities, liquidity, leverage, and future positioning. The net worth statement contains cash, emergency reserves, investments, vehicles, liabilities, and other balance sheet structures. But importantly, not all balance sheet variables evolve the same way. Some compound upward, some decline through schedules, some depreciate gradually, some fluctuate behaviorally. And this means different variables require different forecasting architectures. Now, for the individual who is very attentive to detail, you'll notice that if your assets contain something like investments, then there's two different ways that those investments accumulate. One is through the contribution into those investments, which is really just moving from cash into, in this case, a TFSA, an RRSP, tax-free savings account, a registered retirement savings plan, or some other non-registered type of investment. But there's also the income that's earned on those investments. And that income would have shown up on the personal income statement. So one of the challenges is that in creating this type of an example, there's going to be little issues like that where it's not perfect, but when it's not perfect, I'll try and draw attention to it. But just realize if you have investments, then you'll also have a portion of interest income, dividend income, and unrealized or realized capital gains income that shows up either in the equity section of your balance sheet, your net worth statement, or on your personal income statement. For the vehicles, you'll use depreciation and accumulated depreciation to calculate that net book value. That should be congruent or aligned or consistent, I guess is the better word, with how much depreciation you're realizing on the income statement. And then for your liabilities, there's a number of different assumptions that are going to be made. So in your forecasting, you have to use some judgment because if your investments are going to grow, your ending balance minus your beginning balance is going to tell you the total amount that your investments are, for example. But the unexplained portion, which is going to be the difference between the ending balance and the opening balance, and your accumulations, or your rather contributions, the unexplained balance is going to be the growth, right? So any interest, dividends, or capital gains. And that has to be accounted for somewhere on the income statement or the equity section of your net worth statement. We will discuss that in great detail in further episodes, but for now, that's what's going on there. We have our net worth summary, which is basically our assets minus our liabilities, and we have our 5-year net worth outlook. We have our asset growth, our liabilities decline, and the net worth growth over the 5 years. Okay. We can have our asset composition, our liability composition, key insights, liquidity positions, and any sort of current or liquidity or solvency ratios can be derived on a year-by-year basis once we have the information as a result of our forecasted numbers. So now we begin vertical analysis. Vertical analysis expresses expenses as percentages of gross income. This allows us to identify structural rigidity, scalability, and dependency relationships. For example, transportation may represent 10% of gross income, groceries 9%, insurance 5%, utilities 4%. This matters because many variables behave proportionally to income, meaning they may be forecast as functions of income itself, as I've mentioned. If future income grows 5% annually, some expense categories may naturally scale with that growth, and this creates extremely efficient forecasting systems. Now we examine 3 years of historical financial statements, because forecasting requires historical behavior evidence. We compare how variables evolve through time. Suppose gross income grows 5% annually over these 3 years. Now we compare every variable against that growth rate. Some variables grow at the same rate as income, others grow faster, others grow more slowly. And this tells us which forecasting method is appropriate. For example, transportation, dining, and discretionary spending may grow proportionally with income. These variables may therefore be forecast primarily as functions of income. But now suppose utilities, groceries, and insurance grow faster than income. This indicates inflation-sensitive trajectory divergence. These variables may require trend analysis, inflation forecasting, or compounding structures. Other variables like subscriptions or internet expenses may grow more slowly than income. This improves structural flexibility through time. Horizontal analysis therefore reveals system behavior. Now we arrive at liability forecasting, and this is extremely important because structured debt does not simply trend downward. Structured debt follows amortization schedules, meaning future balances, interest expense, and principal reduction are mechanically connected. For example, a car loan forecast requires opening balance, interest rate, payment amount, and repayment structure. The amortization schedule determines future interest expense on the income statement and future debt balances on the net worth statement. This is critically important because the statements must remain mechanically connected. Revolving credit behaves differently. Credit cards and lines of credit require behavioral assumptions. For example, maintaining balances, increasing balances, or aggressively reducing balances. And those assumptions determine future interest expense and future liability balances. Now we apply the same logic to productive household assets. For example, vehicles. The original historical cost of the vehicle may remain unchanged, but net book value changes through time through accumulated depreciation, meaning the depreciation schedule determines depreciation expense on the income statement and the net book value on the net worth statement. This is another example of interconnected forecasting architecture, because one schedule affects multiple statements simultaneously. And eventually, depreciating assets create future replacement pressure, which creates future liquidity requirements. Now the system requires explicit forecasting assumptions. For example, we may assume gross income grows 5% annually for the next 5 years. Now the forecasting system identifies which variables are driven by income. Examples include transportation, discretionary spending, dining, and some savings behavior. Other variables are driven primarily by inflation. Examples include groceries, utilities, insurance, property taxes, and fuel. Other variables are schedule-driven. For example, amortized debt, lease structures, and depreciation systems. And still others depend heavily on behavioral assumptions. Examples include revolving credit balances, savings rates, investment contributions. This is where forecasting evolves into driver-based systems engineering. Now we arrive at one of the most important concepts in the entire system. The cash flow statement is not forecasted independently. Instead, the cash flow statement is derived from the forecasted income statement and forecasted net worth statement. This is critically important because changes in balance sheet accounts determine cash movement. Examples include debt reductions consuming cash, investment purchases consuming cash, vehicle purchases consume cash, depreciation affects income but not cash, and liability increases may temporarily provide liquidity. Which means once the forecasted income statement and forecasted net worth statement are completed, the forecasted cash flow statement emerges mechanically. This is exactly how professional financial models operate. Finally, once the forecast is complete, we can derive the contribution income statement because the forecasting system already contains cost behavior classifications. Expenses have already been categorized as variable, fixed, mixed, financing fixed, and financing variable. This allows us to forecast contribution margin, operating leverage, or degree of lifestyle leverage, financial leverage, and household fragility. And this becomes incredibly powerful because now the system can evaluate how the household responds to inflation, income shocks, interest rate changes, and behavioral adjustments. This transforms the forecasting system into resilience analysis. Now the system becomes fully operational. Income grows 5% annually. Groceries 7%, utilities 6%. Investments compound upward. Debt balances decline through amortization schedules. Vehicle values decline through depreciation schedules. Cash balances emerge from the interaction of income, expenses, investments, and liabilities. And now the household operating system begins evolving dynamically through time. This is no longer a budget. This is a predictive financial architecture. Because now we can observe future liquidity, future fragility, future optionality, future leverage, future resilience, and future net worth. In the next episode, we begin stress testing the forecast itself, because the future is rarely one straight line. We will begin modeling inflation shocks, income declines, rising interest rates, investment downturns, and changing behavioral decisions. Because strong systems do not prepare for one future, they prepare for multiple trajectories.